Hello and good afternoon. You tune into Market Fatafat. I'm Ankita Saxena. With me is Nupur Talwar Suri, and we're joining you from Suzlon Studio. This is a show where we get you all the buzzes in the trading session. Let's first take stock of how the market is shaping up at this point. Well, taking a cue from the Wall Street, we are also doing well today. In fact, we're sitting at the highest point of the day. Nifty is trading with gains of 0.4%, almost 100% uptick coming in. 24,400 is the level that Nifty is sitting at. So we could close on those highs today. Nifty Bank also following suit is at the highest point of the day. 0.3% gain coming in. 57,360 is where Nifty Bank is at. Let's pull up the charts for the broader end of the market and how that is shaping up at this point. Well, as far as the mid caps are concerned, that is up in a way 0.6%, more than 0.5% uptick coming in there. And the small caps are also trading with gains of 0.7%, so almost 1% uptick coming in as far as the mid caps are also concerned. So it's the mid cap basket that is really leading from the front. Let's talk about the sectoral indices. Look at Nifty IT. Nifty IT has been had been surging for the 5 consecutive sessions till yesterday, but today we do see some profit taking that's coming in on Nifty IT, so that's down and out 1.5%. TCS, Coforge, LTI, Mindtree, Infosys, TechM in that pecking order are declining with cuts of more than 1.5%. Nifty Media and Auto are the top sectoral gainers for the day. But let's move on and talk about an exclusive chat that we had on ET Now. The Pharma Secretary Manoj Joshi says that the government is open to allowing price hikes for specific medicines if rising API costs begin affecting the availability. He clarified that any revision will be considered on a case-by-case basis after companies submit data to the NPPA and ruled out any blanket increase across all drugs. Here's an excerpt of that conversation. Let's take a look.
I think the general approach which we have conveyed to industry is wherever the API prices have gone up substantially, maybe because of West Asia crisis or otherwise, if the industry provides us the data, we are willing to look at increase in prices, particularly where the availability is severely affected. I think the test for whether prices have gone up so much that we need a price revision is availability. If availability is getting affected in the market, we are willing to have a look at the prices. If prices are going up, but still the availability is there in the drug in the market, probably there is a less of a case for price increase. So it depends on case to case, and we look forward to industry providing us data to NPPA and us looking at it.
Okay, so you are saying that the whole issues are being under discussion, or it's being reviewed?
No, there are more than few thousand drugs in the market. So whichever drug industry makes a case to us, provides us the data, we examine it and take action on that. You don't do it across the board because even if the price increases have taken place, across the board increase probably is only the packaging material and some solvents and some transportation costs. Rest differs from drug to drug.
And of course, it is earnings season, and Tata Steel has reported a mixed set of numbers for the first quarter, with revenue and EBITDA largely in line. However, PAT has missed expectations despite rising 12% YOY. Now, Aisha spoke with TV Narendran, the CEO and MD of Tata Steel, who believes that the company is set to achieve its expansion plans, projects 2 million tons higher production in India, and expects to maintain a net debt to EBITDA ratio between 2.3 and 2.5% range ahead. Listen in.
India's delivered well. I think we continue to obviously focus on growth in India, and we've just announced some expansion plans for that. As far as Europe is concerned, if you look at UK, it's progressing towards break even. I mean, every quarter for the last few quarters, we've reduce the losses. I know that's not something to be very proud of, but at least we're moving in the right direction. We are still EBITDA negative, but we were 48 million, I think, last quarter, and we are about 27 million pounds negative EBITDA this quarter. And Q2 will be better than Q1, will not be positive, but pretty close to break even. So I think UK is moving in the right direction, maybe a bit slower than we thought, but we've been helped by some of the trade actions that have been taken recently there.
Would you have a timeline to when Europe is going to break even?
So I think by the end of, certainly this quarter, if you see Q2 between Netherlands and UK will be positive EBITDA, both put together. Okay, because Netherlands is going to do better in Q2 than in Q1. We had some one-off issues in Q1. We are hopefully sorting that out in Q2. So between the two, we will be positive EBITDA in Q2. And UK on a standalone basis, we expect to be positive EBITDA by the last quarter of this year.
Okay. What about coking coal costs? Because they've risen sharply for you, both in India as well as Netherlands, right, in the quarter gone by. And that's clearly weighed in on your margins. Are you seeing any early signs of coking coal prices stabilizing? Or should we brace ourselves for more pressure?
I think coking coal, the problem is always that it's a very liquid market, so it can move very rapidly in either direction. We are guiding Q2 to be about $5 per ton higher in consumption than Q1 in India, and about $10 per ton higher in consumption cost in Netherlands Q2 compared to Q1. So we are seeing it stabilizing. We are not seeing any drop, but hopefully we will see a drop maybe in Q3. But just now, it peaked at $240 coking coal cost. Now it's come down to maybe $230.
Domestic realizations, they've risen sharply, though, on a sequential basis as well. Setting aside the usual monsoon-led seasonality, do you expect this upward momentum in steel prices to continue through the rest of the year?
So if you look at the prices now, flat products is a bit more resilient than long, because flats is obviously helped by the strong growth in auto sector. So we are seeing flat prices more sustainable. Longs, like you said, is impacted by monsoon, and this is a weak quarter for construction industry. So we are seeing long prices drop. So both put together, we are guiding Q2 to be about 1,500 rupees per ton lower than Q1 as far as realizations are concerned.
And your India production volumes, they were up a good 10% year on year. I guess higher output at Jamshedpur as well as Kalinganagar also contributed. What's the volume growth outlook now for India, specifically for the full year?
For the full year, we expect it to be about 2 million tons higher than last year, partly because last year we had a blast furnace relining in Jamshedpur. So obviously that's not there this year, and that gives us additional volumes out of Jamshedpur compared to last year. And Kalinganagar ramp-up is pretty much complete. We have a Ludhiana plant which we've just started, and you will see better numbers quarter on quarter. So we are actually expecting Q2 to be better than Q1, and for the full year, like I said, will be about 2 million higher than the previous year.
You also approved a capex for a 4.8 million ton per annum expansion at NINL. Walk me through the capex plan, phasing, and the expected timeline for this expansion.
So the expansion should take about 4 years, 48 months is what we are forecasting, because it's a big project, and we are building in a site which already has an operating steel plant. So we just need to be a bit conscious about that. But it's an important journey for us from a long products point of view. And the entire Kalinganagar complex, with the flat product complex and the long product complex together, has a potential to go to about 25 million tons. So this will take the Kalinganagar footprint from 8 million to 13, because we have an 8 million ton flat products complex there. The capex will be spent over, while the project will finish in 4 years, the entire capex outflow will probably happen over 5-6 years, because when you're building plants like this, oftentimes the final payments are made after you run the performance guarantee tests and things like that. So we are comfortable that this will be taken care of from our internal generations, so there's no problem with that.
On the UK transformation, National Grid had earlier flagged a potential delay. Tell me, where do things stand as of now? What's the revised schedule? And how confident are you about hitting it?
So it's clear that we will not have the power when the plant is ready, right? And they had indicated to us that it's a 12 to 18 month delay. We are now more thinking that it'll be 12 months and 18 months. We are also working very closely with them to see that even if you don't have the full supply, can we get one line? So the plan that we have is, as soon as the plant is ready, we'll start doing all the cold trials, keep it ready. And if we can get one line, we can, start testing some parts of the plant, etc. So there's a lot of work going on with the National Grid. Firstly, to see can they do it faster. Secondly, with what they have ready, can we at least do some work in the plant so that we are ready to ramp up quickly. So I think we will have the plant ready by 2028, and sometime in 2029 we'll start production when we have all the power supply that we need.
Your net debt rose about 5% sequentially as of June end. Given the capex commitments on the table, which is the UK transformation as well as Neelachal Ispat, should we expect that number to climb further before it comes down?
Not necessarily, because honestly, most of this increase in Q1 has been because of working capital. Because firstly, we've had some disruptions like the direct strip plant in Netherlands, so we had to buy some slabs for Netherlands. Secondly, in Q4, normally there's a cleanup of a lot of inventory, so you're running below optimal levels of inventory in many plants, and you stock up a bit in Q1. So the increase in net debt in this quarter is largely because of working capital. So some of that will go away in the next few months. So we don't expect the net debt to go up, based on the capex that we have planned. I think we will stay well within our plan. And if you see, the net debt to EBITDA is about 2.3 just now. So we wanted to stay in the 2.3 to 2.5 range, and that's very comfortable, we feel, for a company like us at our phase of growth.
And in fact, we slip into a short break, but we will continue to bring you news around the earnings season, so do stay with us.
Welcome back. You're tuned into Market Fatafat. We are taking you through all the stocks that are in focus, and one such company is Indegene that has come out with its Q1 earnings. And my colleague Merrill caught up with the CFO Suhas Prabhu on the performance and the way forward for the company. Let's listen into the slice of that conversation.
Very strong start to Q1 with 40% year-on-year growth on the revenues, and a broad-based growth with our customers crossing 100 active customers, and our revenue per employee also trending north of 77%. But as you also pointed out, the margins are stable and resilient, with EBITDA at 16.9%. But what we would like to highlight is that we have a path to moving towards the 19 to 20% range that we have performed at in the past. There are two factors. One, investments that we did ahead of the curve that we alluded to 2 quarters earlier, which has impacted about 150 bips or 1.5%. And the second is the ramp up of new engagements, strategic engagements such as Tectonic and Omni-channel engagement, one of our largest deals that we signed up in the recent past, which have gone live, where the costs are already getting incurred, but the revenues are getting deferred to Q3 of the current fiscal year. So we believe that Q3 and Q4 is where our margins at a EBITDA level would be back in that 19 to 20% range.
Got that, Mr. Prabhu. Thank you for clarifying on the EBITDA front. But on your PAT as well, your PAT just grew at 13% while your revenues almost grew at 40%. And you earlier said that you'd guided for a significant upward movement in PAT through FY27. So tell us if that margin trajectory, that PAT margin trajectory is still intact, and what's your updated timeline on that?
Yes, the PAT sequentially has grown by 300 basis points, so 3% to 10.9%. And this is also going to grow in the line with the growth in EBITDA. And more significantly, the inflection in EBITDA that we see in Q3 and Q4 will also see a significant positive movement on the PAT. Though I would like to also remind of one factor, which is the non-cash charge, given the large acquisition that we did in Q3 of last year, will continue to have a higher amortization charge, which is a non-cash charge, impacting PAT by about 1.5% against historic levels, which was in the 14.5% levels.
All right, that's wonderful. Let's touch base upon your revenue per employee. That has crossed over $77,000. And you've said that this is also the highest among your peer group. Can you tell us how you're achieving this? And is there an AI aspect to this?
Yes, and thanks for highlighting that. And this is something that we have been continually tracking internally. And if we look at the trajectory since listing, we were in the vicinity of $55,000 to $60,000. Last quarter, $75,000, and now $77,000. There are two factors. Yes, Gen AI is certainly one of them. But more importantly, is also our engagement model, which is outcome and output-based models in our contracts with customers, where we get paid for output and outcome. And the impact of Gen AI, therefore, is able to be retained and strengthened by Indegene and doesn't get passed on in the form of a lower billing, because we are not charging on an effort or time and material basis in our engagements.
Got that. You also mentioned that healthcare domain experts now make up almost 30% of your delivery workspace. So how does that shift in workforce composition tie into your margin recovery story for the second half of the year?
I would say that's a conscious effort. As Gen AI is impacting all of us, there are certain tasks such as coding and programming and the like, which are getting more and more automated using Gen AI. But what is needed to deliver the outcomes that our customers are looking for is the deep domain contextualized for the life science industry. And that is why we are seeing a continuous shift over the last 4 years. Our domain layer, which is the medical domain layer, has increased from 22% to 29% of our workforce. And this provides us the edge in the marketplace as we go deeper and more upstream with our customers. And this is also going to have a impact on not just the margins, but also on superior growth as we go ahead.
All right, understood. And tell us about Biopharm. In the last quarter, you said that G&A synergies were expected to start showing from this quarter, and you're also expecting further synergies to come in for the rest of the year. So how have those synergies started to flow through in the first quarter, and are they still on the timeline that you'd originally laid out for us?
Yes, Biopharm has been a very good acquisition. It has integrated well with our campaign and omni-channel business, which is part of the enterprise commercial segment at Indegene. While this segment and the revenues continue to grow, as you rightly said, the synergies from that have also started reflecting. The G&A integration is complete, and we've realized some synergies there. But going forward, we are also looking at synergies on the technology and data front as we bring together the platforms and the data sets of both Indegene and Biopharm together and go to market. And as we scale, there will be further operating leverage coming out of the operations of the omni-channel business with which Biopharm has integrated.
Got that. You'd also spoken about Tectonic now scaling to 5 customers, with the Germany engagement with your largest client seen as a catalyst for the full year FY27. Can you give us an update on how the Tectonic progress has been in the quarter gone by, and whether that largest customer relationship is also moving forward as per plans?
Yes. So in the last quarter, we signed up for the German region with our largest customer for the upstream Tectonic scope of business. While the engagement go live got deferred and was off to a slower start than what we anticipated, what is promising is that we signed up with the same customer for a new region, the Spanish hub, in the current quarter. And both of these, the German engagement has already kicked off, though delayed, and the Spanish one is expected to kick off in the current quarter. And that shows that not just the promise of the engagement, but also the conviction of the customer to take this further and deeper within their organization.
All right. Well, with that, we need to wrap up this edition of Market Fatafat. But before we leave, let's quickly take stock of how the market is shaping up. Friday afternoon, we are just an hour and a half short of closing the markets, and it seems like we are going to close on a higher note. In fact, if you look for the week, if we end up closing at the highest point of the day, we will be up almost 2% on the Nifty, and Nifty Bank also is trading up right now. Though we have pulled up from the day's highs as far as Nifty Bank is concerned. 50 points cool off that's coming in on Nifty Bank, but nonetheless we are still managing to hold forth with gains of 74 odd points. Broader end of the market is also doing well, especially the mid cap names, 0.6% uptick that's coming in. Especially names like if you look at a couple of names that are doing well in trade, we have a Swiggy that is trading. It's trading up. Ashok Leyland that's trading up almost 5%. We have BSE that's up 2.5%. We have Polycab that is also up 2.5%. And all of these names are really buoying the sentiment as far as the mid-cap pack is concerned, which is, leading from the front. It is the outperformer for the day. But with that, it's a wrap on this edition of Market Fatafat. Nupur and I will take a leave. Thank you so much for tuning in.